So California's got a FAIR plan. It's their state-run insurance. That has run out of money, and I don't know if you've heard this, but a massive wildfire happened in California. So California homeowners will have to fund half of the high-risk insurer's $1 billion bailout. This isn't pretty. Let's get into it. Here we go.
Across town in the Pacific Palisades, the Andonian family stunned by the complete devastation of their community, too.
I froze, literally.
When you saw your home.
Sorry. And then the next house, and the next house, and the next. Oh my God.
Two different neighborhoods, two different life stories, but similar in one way. Both families are on California's FAIR plan, the state-created insurer of last resort that has more than doubled its number of residential policies in the past 4 years, as private insurers have either drastically raised homeowners' rates or simply dropped them. The Edwards family says they were dropped by their insurer last year and struggled to find a replacement.
And they said, no, sorry, we can't cover you for your home insurance. You're too close to the fire zone.
Current estimates for the Los Angeles fires show insured losses are already about $25 billion. For just the FAIR plan, it's as much as about $8 billion. The challenge, according to the California Department of Insurance, the plan only has $377 million available to pay claims and about $5.75 billion in reinsurance to help cover the plan's losses. It's a scenario the FAIR plan's own president warned about last year.
We are one event away from a large assessment. There's no other way to say it because we don't have the money on hand, and we
just had that one big event.
We have a lot of exposure out there.
In September, Insurance Commissioner Ricardo Lara issued this bulletin outlining a new agreement for what might happen should the FAIR plan ever run out of money. The memo allows the insurance companies who make up the plan to request permission to have FAIR plan policyholders share the costs, meaning their rates could soar.
He's not doing his job. He's not protecting consumers.
Democratic Congressman and former California Insurance Commissioner John Garamendi critical of the deal Lara made.
The reality is the commissioner has not been transparent, and he's not forced the insurance companies to explain and to justify what they are doing.
We talked to Commissioner Lara last week, 2 days after the fires started. Can the insurer of last resort sustain this?
So currently, right now, we don't know how many policies are in the insurer of last resort that we call the FAIR plan. We're going to get a better picture once the fire is contained.
The FAIR plan also saying
the answer to that question was no. No. And that's basically, it's too early to determine if an assessment will be sought. I mean, this was kind of a no-brainer. Let's see. We got how much coverage? How much do we have on hand? $377 million. And then we're going to have backdrop fill of, $5 billion, whatever. How many billion in exposure does the FAIR plan have? A lot. In a nutshell, that is where we sit. And so this fund has basically run out of money. Just no mas. After saying would run out of funds by March, California's last resort fire insurance provider will impose a special charge of $1 billion on insurance companies, which will in turn pass those costs along to homeowners. The first such move in more than 3 decades. State Insurance Department today approved a request from the provider, the FAIR plan, to impose the charge and ensures it stays solvent as it covers claims from victims of the Los Angeles County fires. Department said in an order by Commissioner Ricardo Lara, most California home and fire insurance customers will see temporary fees added to their insurance bills as part of the charge, known as an assessment, marking the first time insurance companies will have imposed an assessment directly on customers because they've run out of money. They had too much risk. Everybody knew it. The insurance companies knew it. The homeowners knew it. The homeowners were getting denied left and right. State Farm was pulling out. Everybody else is already pulled out. You've got this FAIR Act, which is basically just high-risk insurance. And the way it's set up is it can't even take a moderate catastrophe, let alone a massive one like we just saw. Pacific Palisades, Altadena, just all those communities. FAIR Plan is a pool of insurers required by law to provide fire insurance to property owners who can't find insurance elsewhere or who have been denied. Why were they denied? Too much risk. The insurers, I mean, they're basically just odds makers, right? They're bookies. And they look at they analyze the situation. You know what? We got a high risk fire deal here. Fire has gone throughout this community many times before. Odds of it happening again are super high. And the way that the state of California has capped their ability to raise the insurance rates to cover said exposure and risk, a lot of companies said, no, we're pulling out. So a lot of this falls on the state of California and the way that it is handled fire insurance in general. So now it's going to be super difficult to, number one, get a fire insurance policy. And why is that, if you're in an area that has impact from it? And why is that important? Because you can't get financing. You can't get a loan without insurance. And if you're in a fire zone, lender may require it. The lender's going to require homeowners insurance, right? And if they look and see, well, this is pretty damn close to the fire zone, most insurance companies are going to go, did you see the news over the last XYZ time period? Had the little thing called the California wildfires. And they just went crazy, right? So this is the end result of that. So who's going to end up picking this up? Well, the taxpayers will. Because we'll have a little federal bailout, and then the taxpayers will, they will basically subsidize the raise in premiums for everybody. Because the insurance companies, they got to spread out this risk, right? They're going to have to get the money back in somehow. Otherwise, they go bankrupt. And that's literally why you've got the FAIR Plan in place, is because so many insurance companies have already pulled out. There's not enough coverage for all the folks out there. And how many people flat don't have fire insurance? A ton. And they're just basically out of luck. One of my podcasts yesterday was how we had a lot come on the market at $9.99 in Pacific Palisades, and it sold for way over list price, probably $1.5 million. And kind of, that podcast is out there. It goes, I kind of go through all the numbers, and ultimately people are taking massive cuts on what they could have got, had their home still be standing. They're taking massive cuts on what they could have made because they want out, because they know moving forward, hey, I might not be able to get insurance, or I won't be able to get insurance. I've already been denied. Can't get insurance, can't rebuild it, don't want to rebuild it, don't want to take the years and years and years it's going to take in a state like California where everything is just regulated absolutely to the hilt. It's one of the reasons that businesses are leaving left, right, and center. Realtor.com, moving from California to Austin, Texas. Another podcast earlier this week. You've just got business entity after business entity leaving the area, not only because you've got, inherent fire risk in an area that hasn't done the normal things like having water in your reservoirs, clearing out the brush, all, basic fire management. And the insurance companies knew this, and the insurance companies had history on their side, which is, hey, fire's going to come through here. So this moving forward, you're just going to have some massive, massive bailouts. There's no other way. There's no other way. And the rich are going to get richer. And I say that from the standpoint of the only people who are going to be able to buy lots are those who are going to be able to build or hold on or hang on and basically profit from this down the road. This is not let's sell my lot for $1 million because I'm making a killing. This is, I'm selling my lot for, $1.5 million to get out and to move on and get away from the fire risk. So its customer base has grown. This is the FAIR Plan. Has grown dramatically in the past several years as insurance companies have increasingly refused to write or renew policies in the state, citing increased risk of wildfires. It now has more than 451,000 policies. Some of the things that have gone into private insurance companies not being willing to insure in California have to do with the way that California has capped fees on this type of insurance. And at the same time, you've got costs to reconstruct have gone through the roof. So you've got a cap on fees that can be charged. Expenses have just absolutely gone up. You've got greater instances of fire actually happening. People are blaming, blame the big corporations because they're the ones that are causing all of this climate change. So yeah, let's go ahead and blame your big corporations. But at the end of the day, you need fire insurance. You need to have fire insurance. And if you don't, you're going to go to one of these Fair Plan Act deals where you're paying way more insurance and you're getting way less in coverage than you would through a regular private insurer. But you've been denied with the other regular insurers like State Farm or whatever it is, right? Many LA fire victims have insurance through the Fair Plan. Residents of Pacific Palisades, where thousands of structures burned last month, held 85% more Fair Plan policies in September than they had a year prior. Almost doubled. Because insurers were pulling out left and right. State Farm had 1,600 policies. I forget what percentage that was. A third of their policies just basically got pulled because the company said, we don't like the odds on this. And you know what? From a business standpoint, the insurance companies were 100% correct. They called it. And now consumers are the ones that are going to have to, bite the bullet and do this bailout. And you're going to have federal bailouts. You're going to have all kinds of bailouts. So otherwise, this just isn't working because the numbers in California, they don't work. Fair Plan Assessment is the latest insurance fallout from the LA fires. State Farm, California's largest property insurance provider, recently asked for permission to temporarily raise its premiums an average of 22%. We covered that one. Because of the claims it's facing from the fires, the insurance department is still considering that request. These insurance companies got to bring more money in because they're spending so much on their exposure because it's happening. Houses are burning down. How many thousand homes went down? 10,000, 12,000, 16,000. I think it was 16,000 structures total and something like 10 or 12,000 homes. The Fair Plan's president, Victoria Roach, have been warning. She's been saying, hey, the day is coming. And if you looked at the numbers, you're like, okay, well, this fire, that's going to do it. Game over. And that's literally what's happened. So the Fair Plan president's been warning about its ability to pay claims in case of catastrophe, telling its state assembly, that's what we saw last year, that the plan, one event away from a large assessment. We're going to need to assess you because we ran out of funds. I mean, everybody saw this coming. Everybody who has been following this issue saw this one coming. I don't think anybody is surprised. What is surprising to me is that the state of California just basically kind of let this happen. They just let this happen and didn't respond. And you know what? California's got so many issues going on that they can only get to so much. And this is the kind of thing that's going to happen. Your consumers are not going to be able to get insurance, or if they can, it's going to be prohibitively expensive. Like, oh, we can't afford that. Let's not do fire insurance. Okay, but my lender is requiring it. Okay, what do we do? And then you're in one of those Mexican standoff situations, right? Where everybody's just like, well, what do you want to do? Well, what do you want to do? Not going to happen because you can't rebuild if you're getting a mortgage, or if you've already got a mortgage, your options are going to be limited. So California Department of Insurance approved the Fair Plan's request to collectively charge private insurance companies $1 billion in order to help pay these claims. Department announced yesterday. Without it, the Fair Plan would have run out of money by March, according to the official order. It's the first time in just over 3 decades that the Fair Plan has turned to private insurers for money because they have to. Leadership in California is largely to blame for this. They just are. They've rigged kind of how the insurance goes, and then they haven't allowed for major catastrophe, which was I mean, it was almost a sure thing, right? There's just a known quantity. So when you've got a system that is literally set up this way, and then you do have one of these deals, this is not going to be just $1 billion. It's going to be multiple billions here and there, because otherwise this system is just insolvent, and California needs to be able to kind of get things going back. But literally the only people that are going to be able to rebuild are the very wealthy, because there's going to be just a huge demand for the services that are going to be required to get people up and running. Architects, contractors, subcontractors, excavators, everybody in that whole pipeline, right? And those are not easy, small processes. These are huge, huge processes that take years to build a normal home. And now you've got how many homes that have been burnt to the ground, burnt to the crisp, that need to be rebuilt in order for people to have that housing? Thousands and thousands and thousands and thousands. And that ain't happening overnight. So the only people that are going to be able to wait this out, are going to be able to, actually do something, are people with a lot of money who can either make it happen overnight, who've got an architect on speed dial, right? Talk about you having your drug dealer on speed dial. You got your architect, you got your general contractor, you got all your subs lined up. Hey, who do you got for concrete? I got Jimmy. Right? You need to have all that set up, and most normal people don't have that. So people in real estate, people in construction, they're going to have that inside track. But even still, just getting all the concrete trucks you're going to need to pour these foundations, getting all the excavation equipment in there to just basically, start tearing it out. Enormous project. And if you don't have insurance money, what are you going to do? All right, I'm just going to write a check from my slush fund. No, these are multi-million dollar deals. And you know what? The FAIR Act, I'm not sure if this article covers it, but the FAIR Act only covers up to $3 million in rebuild. And that's if your insurance company says, yep, it's going to cost that much. Here's your check. There's no guarantees in this process. So a new agreement brokered last year by Insurance Commissioner Ricardo Lara and the FAIR Plan means insurers will be able to pass along half of the extra charges, in this case, $500 million to their policyholders. Well, we know we're insolvent, therefore, let's charge the consumer, because that's the way it's got to go. Short of, these big federal bailouts, right? When divided up, the payment to individual policyholders is likely to be small. Without factoring in businesses, $500 million split up among the 8.3 million California households insured by the private market is roughly $60 per policyholder. It's going to be more than that. It's, at the end of the day, it's going to be way more than that. But we're talking about a stopgap right now, because the FAIR Plan is insolvent. It doesn't have enough money to cover its current outstanding obligations. And like the person who's running the program said, we just don't have the funds to do it. Each insurer will be charged according to their market share. This is divvying up the exposure of the FAIR Plan that they can't cover. Each insurer will be charged according to their market share of residential and commercial policies, meaning if Allstate covers, or State Farm covers 30% of all insurance in the area, then they're going to have 30%. Is what their obligation will be. It's based on market share. The charge will appear on policyholders' bills as a one-time fee. And they also told us that inflation was going to be transitory. And a one-time fee. Okay. All right. But whatever, rather than a rate hike. So, I feel so much better. They're charging me one time a bunch of money. Okay. That's great. That's great. Homeowners who get their insurance through non-admitted, also known as surplus line insurers, will not be charged, but that's a minority of the state. Just 41,500 policies as of 2023. The Department of Insurance plans to issue guidelines on how insurers can calculate the divvying up of the cost to individual customers, according to Deputy Commissioner. All right. So Let's take a look here. This is a market share for home insurers in California. You got State Farm, and State Farm almost covers as much insurance in California as the other top 10 insurers, excluding the Fair Plan, which is the state-run plan, Farmers, Mercury, and Auto Club. There's 10 insurers that have almost as much exposure as State Farm as just one insurer. So you've had most of the insurance companies have pulled out of the wildfired areas and pulled out of California. And, you've got other factors in there as well. State Farm doesn't just insure in California. They've had some massive, massive issues. North Carolina, you got that. You've got Maui. You had Lahaina happen. You've got these issues that come up that are literally billions and billions and billions of dollars of damage. Same insurance companies are on the hook for that as well, right? On the hook for that as well. So the $1 billion payment, known as the assessment, it'll supplement the funds for the Fair Plan's reserves and what it expects to recover from its reinsurance contracts, which is insurance for insurance companies. So they're going to try and, hodgepodge this together. They'll just need to kind of keep on it going. But the Fair Plan must first pay out $900 million to meet its deductible. Imagine your deductible is $900 million. Well, they're a company just like any other company. Except they're state run, and they've got certain criteria, right? 900 is their deductible. All right. After that, we'll let the reinsurance kick in. After that, it can begin collecting in part from its reinsurance and in part through industry assessments. What a mess. What a mess. But that's what happens when you've got a known issue like wildfires in California and your insurance system isn't capable of handling the risk. And everybody has known that. And what has been done? Well, let's put this state deal together. Yeah, that might work out. But man, if we have the big fire, which California just did, we are hosed. So California Fair Plan running out of money, it's run out of money. When those fires happened immediately, it ran out of money because we know that the cost to rebuild all that stuff, their exposure is way, way, way beyond what the state has set up in this fair plan. And nearly all homeowners to help bail it out. No, I think eventually, because anybody with any kind of consumer purchase is going to pay one way or the other, because you got to spread this out. It's such a huge, huge number that it's not just going to be, it's not going to be just insurance. You're going to have all kinds of stuff that costs more or becomes unavailable or just, is impacted because of the magnitude of this fire. All right. So I expect to have plenty more of these podcasts down the road. Make sure you're subscribed, hit that notification bell, all that good stuff. And I'll see you on the next one. Thanks again for being here. Bye for now.